In early 2023, the American economy was riding high. Inflation had cooled from the painful highs of 2022. The stock market was recovering and job growth remained strong. Consumers were spending, wages were rising, and confidence was slowly returning. But beneath the surface, something was simmering. Talks of decoupling from China had turned into policy drafts. The Biden administration had passed the CHIPS Act to boost domestic semiconductor production while also restricting exports of high-end technology to Chinese firms. In response, Beijing began quietly stockpiling critical materials and forging deeper trade ties with BRICS nations. Then came 2024 and the tone shifted dramatically. With President Donald Trump returning to office in January 2025, his administration moved quickly to reignite its tough stance on trade. Trump's team claimed that previous deals had been too soft and that America was still bleeding wealth through lopsided trade with China, Mexico, and even the European Union. By March 2025, Trump had signed executive orders imposing fresh tariffs, 25% on Chinese electronics, 35% on EV components from Mexico, and 15% on European steel. Wall Street reacted instantly. The Dow dropped 700 points in a single day. Tech stocks, heavily reliant on overseas components, plunged. Economists began to warn that we were entering a new era of trade war, but this time, the stakes were even higher. Unlike the skirmishes of the late 2010s, the 2025 trade war began during a time when global supply chains were still recovering from pandemic-era disruptions. That made the fallout faster and fiercer. Small business owners who had just stabilized their inventory after years of chaos were suddenly facing massive cost increases. A Brooklyn-based electronics retailer interviewed on CNBC said his prices would rise by at least 20% overnight due to the tariff hike on Chinese imports. Consumers, too, started feeling it. Grocery prices, which had been gradually declining, started to tick back up. Automobiles saw new price increases as tariffs on car parts kicked in. And American manufacturers hoping to ramp up domestic production found themselves battling labor shortages and raw material bottlenecks. But while consumers grumbled and businesses braced themselves, Trump's supporters cheered. They saw it as long overdue retribution. It's about time we stop being a doormat to China, one Iowa farmer told Fox News. Meanwhile, China struck back. Beijing announced its own wave of retaliatory tariffs on American agricultural products, soybeans, wheat, pork, and corn. They also imposed new restrictions on rare earth exports, which are essential to everything from smartphones to electric vehicles to missile systems. Markets grew more volatile. Supply chains stuttered. Companies began holding emergency strategy meetings. And everyday Americans started asking, is this trade war going to tank the economy? The media began drawing comparisons to the 1930s, when the infamous Smoot-Hawley Tariff Act exacerbated the Great Depression. Were we repeating history or just playing tough before striking a new deal? As the summer of 2025 approached, economists were increasingly divided. Some said the trade war was a bold, necessary correction. Others warned that we were heading toward a cliff and fast. And for Main Street America, the question remained painfully simple: who's really going to pay the price? By the time spring 2025 arrived, the full force of the trade war had hit American supply chains like a freight train. For decades, U.S. businesses had built their operations around a globally integrated model, outsourcing parts and materials from low-cost providers abroad and assembling them in stateside factories or shipping them directly to consumers. But now, with tariff walls rising like concrete barriers across international borders, those once streamlined networks were buckling. The numbers told a sobering story. A report by the National Association of Manufacturers in April 2025 found that 87% of U.S.-based manufacturers had seen a significant increase in costs within 3 months of the new tariffs taking effect. For many small to mid-sized companies, those cost increases weren't just inconvenient, they were existential threats. Take the case of Melanie Davis, owner of a mid-sized manufacturing plant in Toledo, Ohio that produces HVAC systems. Her company relied heavily on parts from China, fans, coils, circuit boards. When the new 25% tariff hit, Melanie saw her operating costs spike by nearly $400,000 per quarter. "We were barely getting back to normal after COVID," she said in an NPR interview. "Now, I'm facing layoffs unless I pass those costs on to customers." And customers were noticing. Retailers began adjusting price tags across the board. From electronics to appliances, from tools to toys, the effects were impossible to ignore. Inflation, which had cooled significantly in 2024, started creeping back. The consumer price index rose 0.6% in March, double the rate economists had forecast. While that may sound small, for households living paycheck to paycheck, every extra dollar counted. The pressure rippled beyond just manufacturers and retailers. Transportation and logistics companies, the lifeblood of the American economy, were slammed with fluctuating fuel costs, inconsistent shipment volumes, and rising insurance premiums due to port delays and geopolitical tensions. FedEx, UPS, and even Amazon had to rethink their shipping strategies, sometimes stockpiling inventory in domestic warehouses just to avoid the volatility of imports. A logistics manager in Long Beach, California, described it this way: "It's like playing chess during an earthquake. You can't plan 3 moves ahead because the board keeps shaking." But it wasn't just the private sector feeling the squeeze. Local governments, especially in trade-reliant regions, saw their budgets tighten. Ports in Seattle, Houston, and Charleston reported significant declines in volume. That meant less revenue, fewer jobs, and slower economic activity in cities that had long depended on global trade to power their economies. School districts tied to local business taxes began preparing for budget cuts. Infrastructure projects were put on hold. And for every family that worked in logistics, shipping, or manufacturing, the message was clear: the pain was no longer theoretical. It was here. In response, the Trump administration defended the tariffs as part of a long-term strategy to rebuild American manufacturing. "It's about strategic independence," said Trade Representative Robert Lighthizer during a press briefing. "We've been too dependent on adversaries for too long. This short-term pain will lead to long-term gain." But Wall Street wasn't so sure. Major indexes remained volatile. Goldman Sachs revised its GDP forecast downward, warning that continued disruption in supply chains could shave 1.2 percentage points off economic growth in 2025. Meanwhile, J.P. Morgan analysts noted that while reshoring efforts were admirable, they would take years to scale, years that businesses might not survive. And then came the unexpected wild card. India, a key ally and trading partner, announced it would reconsider its participation in certain trade agreements with the U.S. if tariffs extended to pharmaceuticals and textiles. This was a wake-up call that the effects of the trade war weren't confined to just 2 superpowers. America's position in the global supply web was more fragile than many realized. As one business columnist put it bluntly, the U.S. economy was built like a Formula One car: fast, lean, global. But you can't race when someone starts yanking parts out of the engine. As supply chains faltered, layoffs mounted, and consumer prices climbed, the public conversation began to shift. Supporters of the trade war started asking, is this really worth it? But for those in D.C., the answer was far from settled. The next moves would decide whether America was playing a winning hand or bluffing in a dangerous game. By mid-2025, the tension between Wall Street optimism and Main Street despair reached a boiling point. In New York, traders watched daily news cycles like weather forecasts, trying to guess which tweet or tariff might send markets soaring or crashing. In towns across America, small business owners and everyday workers weren't guessing anymore. They were living the impact. The third quarter of 2025 opened with a bang, and not the good kind. The Dow Jones Industrial Average dropped another 1,200 points over 2 weeks in July, triggered by China's announcement of additional retaliatory tariffs. This time, the blow hit hard. New 40% levies on American automotive exports, along with strict regulatory roadblocks targeting U.S.-based tech firms operating in Asia. Ford, Tesla, and General Motors shares tanked overnight. Tesla, in particular, saw its Shanghai Gigafactory, the jewel in its global crown, effectively frozen as Chinese regulators launched a surprise audit, halting production and export for over a month. Elon Musk took to X, formerly Twitter, calling the move an act of economic warfare and publicly questioned whether the global EV revolution could survive in such an unstable trade environment. Investors were shaken. Earnings projections were downgraded. But while the financial elite braced themselves, working Americans bore the real weight of the storm. Take small towns in the Midwest, once part of the so-called Rust Belt, which had finally begun to show signs of revival thanks to investment in electric vehicle production and microchip assembly. With the EV market in chaos and raw material prices spiking due to rare earth restrictions from China, these communities were once again facing plant closures and layoffs. In Flint, Michigan, a newly opened EV battery facility announced temporary shutdowns. Nearly 400 workers were sent home with severance packets and uncertainty. "We thought we were finally coming back," said one laid-off technician. "Now it feels like 2008 all over again." Meanwhile, across the Southeast, soybean and pork farmers were seeing their exports to China vanish overnight. Containers that once carried millions in goods were sitting idle at ports. The USDA had to revive emergency subsidy programs just to keep rural families afloat. Main Street businesses already squeezed by rising wholesale prices had no choice but to pass those costs along to consumers. The result? The return of inflation. Grocery prices rose. Gas climbed back above $4 per gallon. Construction slowed as building materials surged. Consumers started cutting back on dining, on travel, on discretionary spending. All of this led to one unavoidable trend. The dreaded R-word, recession, began echoing across cable news panels, op-eds, and economic forecasts. The National Bureau of Economic Research didn't call it officially yet, but indicators were flashing red. The Consumer Confidence Index plunged to its lowest level since early 2022. Retail sales dropped for 2 consecutive months. Unemployment, once at historic lows, ticked back up, first 0.3%, then 0.5%. Corporate investment froze, with many CEOs choosing to hold cash instead of expanding amid the unpredictability. But as Washington argued over tariffs and trade policy, average Americans were left wondering, wasn't this supposed to help us? President Trump remained defiant, rallying supporters at town halls and campaign-style rallies. "We're bringing jobs home," he said in a televised address. "The pain is temporary, the gain will be forever." Opponents weren't buying it. Democratic leaders accused the administration of economic recklessness, pointing to historical data showing that tariffs had consistently led to higher prices and job losses. Senator Elizabeth Warren called it a war without a plan, while others warned that a true recession was already underway, even if not officially declared. Some economists argued that the trade war was masking a deeper problem, that the U.S. economy was overleveraged and brittle, and tariffs merely accelerated the cracks. Others said this was the necessary purge, a short-term detox that would lead to a more resilient future. But one thing was clear: confidence was eroding. Wall Street fund managers began shifting assets into safer havens, gold, bonds, and even foreign markets like India and Brazil. Meanwhile, middle-class families were canceling summer vacations and cutting back on back-to-school shopping. The American economic engine, once roaring, was now sputtering. And as more businesses shuttered, more jobs disappeared, and credit card debt soared past $1.3 trillion, the highest in U.S. history, experts warned. If policymakers didn't act quickly, this wasn't going to be a soft landing. It was going to be a crashed as summer turned into fall in 2025. America's trade war wasn't just an economic story. It had become a full-blown geopolitical saga. The battlefield had expanded far beyond U.S. and Chinese borders. Allies were choosing sides, and global institutions were struggling to mediate the fallout. The World Trade Organization, WTO, long criticized for its sluggish response to modern economic threats, found itself paralyzed. Member nations were filing complaint after complaint, but resolutions were months, if not years, away. Meanwhile, back in Washington, the fight over trade policy ignited a fierce political firestorm. On Capitol Hill, Democrats and a growing number of moderate Republicans began openly questioning the administration's handling of the economic crisis. Congressional hearings turned into televised showdowns. Treasury Secretary Steve Mnuchin found himself grilled for hours over shrinking GDP forecasts and faltering stock market performance. "Is this the cost of American greatness?" Senator Josh Hawley asked pointedly during one Senate Finance Committee hearing. But while politicians debated, governors and mayors were dealing with the real-world consequences. In Wisconsin, once a Trump stronghold, dairy farmers held a protest outside the state capitol. Their exports had been wiped out by retaliatory EU tariffs, and subsidies weren't enough to stop foreclosures. "We're patriots," one farmer said, "but patriotism doesn't pay the bills." In Silicon Valley, tech giants like Apple, Nvidia, and Intel were forced to shift supply chains almost overnight, investing billions into India and Vietnam. It was a necessary move, but it meant lost jobs and disrupted innovation pipelines in U.S. cities like Austin, Seattle, and Raleigh. And then came the global domino effect. Europe, frustrated with U.S. unpredictability, signed a new regional trade pact with Japan, South Korea, and Australia, bypassing American businesses entirely. This was a seismic shift, effectively forming a new economic bloc that could challenge U.S. dominance in tech, energy, and finance. Meanwhile, China deepened its economic ties with Brazil, Saudi Arabia, and even Russia, locking in long-term oil, gas, and grain contracts. American businesses, now shut out of key markets, were left scrambling for alternatives. The United States is isolating itself economically at a time when global cooperation is more critical than ever, warned economist Paul Krugman on CNN. This is not strategy. This is economic seppuku. Even America's military readiness wasn't untouched. A classified Pentagon report leaked in September revealed troubling vulnerabilities in defense manufacturing. Titanium components, rare earth magnets, and microchips, all essential to fighter jets, missiles, and radar systems, were heavily imported. With tariffs and counter-tariffs snarling supply, defense contracts were experiencing delays. The White House pushed back, arguing that short-term sacrifice would lead to long-term independence. "This is about sovereignty," Trump said during a rally in Arizona. "We will never again be at the mercy of a foreign nation for our security or prosperity." But critics saw a different reality, an increasingly chaotic game of political chess with the American worker as the pawn. In Washington, think tanks were split. Some praised the administration for finally confronting China's unfair practices, IP theft, and currency manipulation. Others pointed out that a multilateral approach, working with allies rather than antagonizing them, would have achieved similar goals without destroying global trust. By October, the U.S. economy had officially entered a technical recession, 2 consecutive quarters of negative GDP growth. Though the downturn wasn't as deep as the 2008 crisis, it was widespread and uneven. Wealthier Americans adjusted, they moved investments, cut discretionary spending, and waited it out. But low-income families, service workers, and small business owners? They were drowning. Adding fuel to the fire, presidential campaign season had kicked into high gear. Candidates on both sides were turning the trade war into a central talking point. Trump doubled down, arguing that the recession was proof that the global system needed to be dismantled and rebuilt in America's favor. His opponents countered that the chaos was self-inflicted, a political stunt gone nuclear. And then came the unthinkable. In a surprise move, Mexico imposed tariffs on American corn and wheat, accusing the U.S. of violating agricultural export agreements. This wasn't just about economics anymore. It was about reputation, respect, and America's role in the world. For the first time in decades, the question wasn't whether America could lead the global economy, it was whether it could even keep up. By the final quarter of 2025, the U.S. stood at a fork in the road. The recession was real.